We're looking at credit worthiness. We're looking at your credit history, your credit score, see how well your payment history is, how well you've paid your bills in the past. That will determine how you're going to pay the new obligation for a house. In considering a good credit score, we like to see 740s or above, but there's different loan programs for different credit scores, as low as 580. So after we pull your credit, you get your pre-qualification. An important thing to remember is don't pull any more credit, don't get any new credit during the home buying process, because you don't want to increase your debt to income ratios if you're right there at that threshold anyway, because that could potentially ruin your chances of getting a loan and getting approved. Credit report's going to tell basically your current debts that you have financed. That doesn't include any cell phone bills, utilities, or anything like that, but everything that's financed, cars, credit cards, things of that nature. That's what's included on your credit report. Basically what we're looking at there is how well you pay those, and that will tell us your debt load. So when we're looking at debt to income ratios, that's how we calculate it. The things that affect a person's credit score is going to be things like your payment history, whether it be positive or negative. It can have a either or effect, and then just how much debt that you have currently, because the more debt that you have, the more potential your score is going to be lower than higher. So you want to keep a good even balance ratio on your debt load. Okay, as far as your credit score and how it affects your interest rate, obviously the higher the score, the lower the interest rate. So the higher you can get that score, the more money you're going to save month to month on your housing payment. Of course, obviously we do have programs that will fit multiple score ranges, but if you're in the market now and your score is not quite where it needs to be, my recommendation would be to take a little extra time, get your score up, so you will save that money in your interest rate on a monthly basis. And just have a diversified credit portfolio, basically credit cards, installment loans like car loans, personal loans. That'll help diversify your credit enough and get you a good, strong score.